Quite a big reaction to your numbers today. I was going back, I couldn't find a reaction like this for really quite some time. Any sense of kind of why? Performance fees seem to be the excuse. Is that it?
Yeah, well, I think there's a lot of good coming out of this period. Assets under management were up by 16%. We have real structural demand for the products and services that we provide. We earned a very stable management fee, which has been consistent since our IPO in 2006 of about 128 basis points. At the same time, we make a return, we make a cut of the profits when we sell investments. And the market was expecting about 137 basis points of performance fees. We delivered 127 basis points, and the market's been chewing on that for the day.
It certainly has been. The bigger picture here, though, is that money continues to absolutely flood into private markets.
Yep.
Private markets increasingly on a par with public markets. Do you see anything that's going to stop that trend?
I wouldn't say there's anything that's going to stop the flow of capital from public markets into private markets based on what we see today. We see real structural demand from institutional investors around the world looking to add more yield into their portfolios. And private equity's been a relatively small allocation historically, a novelty allocation for some, 1%, 2%, 3%. But as yields become harder to find, people need to search for returns. Private equity is becoming a bigger part of the story.
What are you finding in terms of exits, David? Is the environment changing? Is it less attractive to actually exit now?
So we made a couple of calls in the first quarter of this year to postpone some liquidity events. We had seen transaction activity down about 30% from the first half of 2018 to the first half of 2019. At the same time, there's been a meaningful pop back in volumes. We have a number of liquidity events that our firm is pursuing at the moment, and we think it was more a short-term blip as opposed to a long-term structural change.
What do you make of what's been happening with the major Silicon Valley companies like Uber, like Lyft, obviously WeWork, which hasn't gone public yet? You know, valuations are a little bit under pressure in the sense that investors seem to be wanting more proof right now. Is that also a blip?
I'm not sure if that's a blip or not. I think the reality is there have been probably 180 IPOs that have been postponed over the first part of this year, and part of that is from investors really wanting to see more proof. I think WeWork is the latest, and I think investors are going to require not just a story anymore. I think they're going to require a consistent track record, and I think that's here to stay.
Let's talk about what investors really want right now, and that is anything that is safe.
Yeah.
Defensive, safe. You call it what you will. Bond proxies in the private markets are doing well. Bond proxies in the public markets. You look at Nestle,
yep.
Companies like this. The valuations that are attached to some of these companies, the multiples they trade on, absolutely eye-watering. And the dispersion from one end of the market down to value,
yep.
From value at the bottom up to these guys, it's just extreme, and it's probably more extreme in the private markets. Again, let me ask you, how far can you stretch that elastic band?
I think it's a great question. So when we look at what's happening in private markets today, I think this search for yield that people have pushed them into private markets, and yet people know that it's a fragile environment that we're in at the moment. And so they're looking for anything that has that sticker that says secure, anything that has that sticker that says defensive, and they're bidding up those prices. We've seen unprecedented valuations for many defensive assets today. And so as opposed to being the next person that jumps in after that next defensive deal, we think that the valuation premiums that are being paid, the leverage that are being added to those businesses largely negate the defensive characteristics that the underlying
yep.
businesses have. And so we believe that offense is the new defense. Instead of believing that a position in a defensive business is going to carry us through. We're looking for situations where we can actively build defensive characteristics in slightly smaller businesses. So maybe it's not a stable global platform today, but it's one that we believe that we can help them convert their business model over from maybe a transactional model into a more of a recurring
You're still trying to create
model.
the same thing. You're
trying to
so that
recreate.
defensive desire is not going away anytime soon.
Not going away, but we're saying you have to be active in building it as opposed to hoping you can just go buy it in the marketplace because it's too expensive.